Hey folks, welcome back to Code and Concrete, where we share the latest trends and the stories of trailblazers in the built environment. I'm your host, Matthew Schneider, and I'm currently calling in from Boston, Massachusetts for Boston Blockchain Week. So I'm out of office. This is an unusual setting for me. But today I've got an extra special guest. I have Denis Petrovcic. And he's the co-founder and CEO of Blocksquare, leading a team that's building infrastructure that transforms real estate into borderless tokenized assets. And you know that we're crazy about tokenization over here. So since 2018, Blocksquare's protocol has tokenized over $200 million of property across 20 countries. And through Oceanpoint, they enable instant DeFi-native secondary market liquidity within a framework designed to reassure regulators and investors alike. He's a serial founder in hospitality, e-commerce, energy tech, and he discovered Ethereum back in 2016. So he's an OG, I guess you could say, and he certainly became convinced that the future of real estate finance was on-chain at that point. He focuses on product architecture, capital strategy, policy design, and also serves on the board of FIBREE to help advance global standards for real estate asset tokenization. Well, Denis, welcome to the show.
Hi, Matthew. Thanks for having me.
Yeah, it's my pleasure. You and Blocksquare have certainly done a lot for real estate tokenization in the past few years.
Well, it was a tough road. I mean, getting from a concept that nobody knew about or nobody cared about, people in crypto, in Web3, and back then it was not DeFi yet, really. They didn't care about tokenizing real estate, really. People in traditional finance, in real estate, didn't care about tokenization. So there was a big gap. And we're seeing nowadays that this gap has closed or is closing in. And there's more and more interest from both sides of the spectrum.
I agree. We're seeing that as well. Around what year do you think did you recognize real estate tokenization as something that was genuinely valuable and a good use of blockchain?
It's hard to say realized, because I think the conviction part is definitely something you need to stick to it, right? You have a conviction, and then you lose that conviction, and then you gain it again, and so forth. So it's a cyclical thing for an entrepreneur that decides to dive into this. But the first time really that this kind of crazy idea of tokenizing real estate or putting real estate value on chain somehow came to existence was back in 2016. So we formed like a blockchain lab. A good friend of mine and now co-founder of Blocksquare. His background is in IT development, has an IT development company, and I kind of came across Ethereum and smart contracts, and that kind of really spiked my interest. That was like early 2016, and then we started discussing things, around beers and just discussing, how that might be interesting or not, like smart contracts. And then we started officializing this discussion. So we went from drinking beer and discussing about it to actually doing something in their office, and then trying to see if this thing makes sense or not. And we were researching different verticals, and I had at the time my first kind of real estate investment privately done outside of my primary home. And that kind of then spiked my interest. Could this be applied on the real estate vertical, and where? So we were looking at different aspects, how this could be, what implication it might have. And here in Europe, we have this thing called land registry, and it's national. So each country has its own land registry. and it means that this is totally governed by the state, right? Title transfer. And the infrastructure is super old. So we thought, blockchain is going to definitely have an impact on how land registries function. But we saw that this is like a top-down approach where governments need to get involved. And then on the other side, we saw that there's this financial element to real estate, right? When you invest into it, and it's a bulky, big asset, and so every time you need to do it or you want to do it, it's very intensive. It's heavy. It's not something that's built for everyone. And by tokenizing, you could essentially fractionalize access, and essentially somebody could buy into it with a couple dollars in essence. So that kind of spiked the interest, and then we went into creating a concept for it, and just didn't stop coming back to me.
Just for my curiosity, I've got folks that call in from all over the world. What country are you calling in from?
Calling from Slovenia right now. So
Okay.
I'm based out of Slovenia, Ljubljana. Yeah.
Okay, super interesting, and I think right off the bat, we can recognize that there's major regulatory differences. I'm here in the US, and so when we're talking about tokenizing deeds and ownership, there's these stark differences between how that's executed between the jurisdictions. And we've seen certain cities and countries around the world start to lead the way with authentic tokenization. It hasn't scaled everywhere, and we're still like using SPVs and other interesting wrappers, which sort of disassociate true ownership in the sense and what I think tokenization is trying to accomplish. And I think that's actually, jumping into one of my first questions that I have for you, which is about the misconceptions. I think that the framework of ownership that tokenization promised has still not been realized. It hasn't come to fruition, which is this idea of truly digitally native, transactable, smart contract bound, where it's literally a contract. I often say smart contracts are not contracts and they're not smart, right? It's a misnomer in that way. But what do you think are some of the strongest misconceptions that you've recognized over the years that maybe people were talking about a few years ago as a potential for the technology, and now today we say it's just not true? We don't have it.
That's a good question. I think a misconception that comes from the market. A lot of times we get people who are in the real estate sector, and they believe that financing through tokenization a new project, a new development when it comes to real estate, it's much easier because you have this global audience. And I always tell them, fundraising through fundraising is hard, whatever form you take. There's a lot of risks involved, and with tokenization, you just don't mitigate those risks. You just digitize the transfer value, but the risks stay the same. People expect to be compensated for the risks they take. So I think the misconception is that with tokenization, you can quickly raise a lot of funds and it's a magic wand, and it's not. It's actually, the opposite a lot of times. It, might create even a counter effect when you are fundraising for a development project and you use tokenization instead of traditional means, because if the project is sound, you should have a lot of investors who are not banging on your door. So people are like, well, why are you just tokenizing this and offering to investors through the purchase of tokens? So I think that's kind of the major misconception there. Maybe another one is that by buying tokens, you get title ownership, and as you mentioned, people are not going in the details of how things are structured. How we have, for instance, structured things is that you actually buy economic rights that derive from ownership. So it's not even shares that you're buying in an SPV. So you don't have share ownership, which makes it easier to transact with those tokens later on and stuff like that. It makes it easier to comply with regulation in Europe, but as well in other parts of the world. However, you are not buying a fraction of the title. So you don't have the same rights as the company that owns the title.
Really great point about the silver bullets. And we've seen this over the years, and I've pushed back really strongly against it, especially on LinkedIn, where I'm quite vocal that tokenization is not a silver bullet. We shouldn't overpromise what the technology can accomplish. And you really need to have the right setup, the right use case for blockchain or decentralized ledger to be introduced into a real estate project for fundraising or for data provenance, whatever it is, and then actually be able to realize the value. And I think one of the things that has got this industry in a gridlock is that we're charging a lot for services. We're selling blockchain and tokenization on these platforms. And then what the deliverables are supposed to be, if it's faster fundraising, it almost doesn't even make sense. Like, it's just not how finance works. Or if it's lower cost of capital, someone is making less money. You always have to pay your parties involved. Or if it's accessing new investors, like retail investors, you have to ask why. Why can't you go to the banks or the larger financial institutions or the institutional investors? Is it because they don't like your deal? Because your deal is bad? Is that why you need retail investors? So there's just been all of the issues that have emerged over the industry, and almost like false prophets that have said tokenization can solve all sorts of real estate problems, or that it's going to bring transparency, and the deals were not more transparent, right? You really have to think these things through. And so this leads right into my next point, which is, what are some of the major use cases that you see for blockchain or other decentralized ledgers in the real estate industry, either as a market, an investment market, or as an industry?
Well, you raised some good points. Yeah, transparency is one. Yeah, one of the misconceptions oftentimes is as well transparency, as you well pointed out. But it doesn't need to be like that. So it's, I think, up to players who are providing products, tools within the tokenization space, that we need to focus on providing tools that can increase transparency. So products that will kind of push issuers, in our case, real estate owners, to pursue higher transparency towards their clients, the token holders in the end. And we need to structure this product this way. Now, in terms of use cases, if we before mentioned the use case, let's tokenize this property development to raise, some part of our equity through the sale of tokens, and that's going to be easy then to fill the gap. Depends on the size of the project in the end, and the cost of how you set it up. But essentially, doing a fundraise requires a lot of track record previously, so that people trust in you, that you will not only be able to collect the target amount, but execute with that amount the target, development and the target returns. So if you don't have that track record, it's not going to happen, or people are, will be hesitant. And a lot of times I say, look, if it's a big, CBRE doing a fundraise with tokenization, they're going to do it. They're going to be successful because they have the brand, they have the recognition. But if it's a kind of mom and pop type of business, it's probably going to be hard. Now, in terms of use cases, the biggest use case we've seen when we've tokenized, this amount of real estate assets is equity release. There's been a cycle, and this cycle might be ending, or there might be another 5 years, we don't know, right? But there's a lot of equity locked in investments that people done without tokenization traditionally. So they're sitting on these portfolios of assets that are yielding well, but the yield versus the current yield that these real estate assets are returning versus the investment that they've made is great. It might be even 25%, 30% per annum. Depends on what type of project they did. But when they compare it to the current net asset value, it has decreased for them. And it makes sense for a property owner to consider releasing some of the equity at today's valuation. And that's where, the opportunity for tokenizing, in our view, is the biggest, because it's easy to structure this kind of deal. You have an asset, it has a lease contract, or it has a business plan, it has a financial projection and a financial track record, and you tokenize it. And that then allows people to buy into those tokens. And you don't have a goal, you don't have a target. Either you sell these tokens as a property owner and you gain liquidity, or you don't, and you still have a great investment that you've decided to make anyways. So it's kind of a win-win for the property owner, and on the other end, it's a win-win as well for the token holder. I think that's still the biggest use case currently on the market that is viable, makes sense, and it's sound.
Right. A lot of people talk about real estate being an illiquid asset class, which is this idea that there's a lot of capital locked up. I mean, hundreds of trillions of dollars if you were to aggregate all of the real estate around the world, residential and commercial. Now, when you go about tokenizing an existing property, and if we were to take it at the current valuation, I feel like there's some unforeseen or unaccounted for costs with that, because the information pertaining to that property may not be up to date. So you may have to appraise the assets and obtain a valuation and digitize some information just to begin the tokenization process. And this calls into the question of the accuracy of the tokenized financial products that you're creating based off of the real estate. So where do you see the relationship between asset value and digitization and the data that we have available to us, and then going about tokenizing maybe some of the equity in a real estate project to free up that capital?
I think there's a big correlation between those two, right? And the two, different technologies are kind of growing in, from different starting points at different times they started. But if you look at automated valuation models, which use, aggregated big data and market data and then portfolio data of various companies, then they're able to kind of predict or simulate the valuation in almost live. Let's say they can update it on a monthly basis, essentially. And in some cases, even less. But usually, the reporting done by all those agencies is done on a monthly basis. So that's the interval that usually banks get using those models. And I think that kind of approach to valuation, to setting up net asset value, and the more data we have about a specific market, the more transparency it can be presented to people who want to invest in real estate. With tokenization, what we're doing is we're just making the ease of access or making it easier for people to access those kind of assets. So I think it's going to go hand in hand. But of course, right now, there's still, a big gap between having like a live feed, an oracle, if you will, that will, that we will basically just point on a place on a map, and it's going to recognize the type of building, and provide an appraisal value of it that is accurate. Even if you use online tools to appraise residential real estate, which is the most kind of common automated appraisals that you can get, it's still based off of, dispersed data. It's not so accurate. You have plus minus 10% on the value. That's 20% spread between, the minimum and maximum assessment. So what we see is there's potential with tokenization that we get new valuation models that actually use the small trading volume or the trades that happen on the tokens, which create valuation data itself. And so if you combine those two, you could use data from tokenized markets to feed into automated valuation models, and then back to tokenized markets. And so the velocity of information and the amount of information that you can gather from that cycle can be enormous. And then if you add to it an AI model that can really well process this amount of information and feed it in a human readable way to investors, you get something new. And I think that's the future where this will all lead. Just producing more and more data points for systems to utilize them.
I agree 100%. I like where the conversation is going. So I sort of want to unpack what you're talking about. If I understand correctly, you're saying that the market auction, so the buyers and the sellers trading real estate, would help influence the valuation of the underlying assets. Is that correct?
Essentially, yes. If you look at the stock market, right, the valuations on publicly traded companies is based off of the stock price. And, there's a certain amount of supply of the stock that is being traded. And it varies from company to company. But that's essentially what is used to create a measurement of value on the aggregate value of the asset of, Apple as a company, right? And so that creates a data point. And people trading on the New York Stock Exchange with Apple shares are creating data points. And so the same can happen with tokenized real estate or any other real world assets. It just gives us a glimpse into how much a market is valuing a specific asset at a specific time, period of time on a specific volume.
But do you think that as a lot of real estate is tokenized and you have a high frequency or a high volume of real estate products, they could suffer from continued illiquidity, which in an auction would either introduce volatility or some sort of discount applied to the price. And we see this in major public markets currently where stocks trade. There's a correlation between liquidity and the performance of the markets and therefore the value of the underlying stock. So how do you see a balance between the property value and essentially the market value, what the investors are determining? Because there's always this talk about trading real estate. You tokenize real estate and you could trade it, although it's usually a buy and hold strategy. So how do we ensure that investor behavior doesn't introduce volatility into what should be a very stable asset class?
I think that the main difference between, trading stock or trading crypto or, gold or whatever, is that with real estate, you have a revenue generating asset. I think that element alone creates a different approach when you look into it from a valuation standpoint of view, because in the end, you're looking at, the return on investment without asset appreciation. And then you have the speculative part, which is kind of asset appreciation over time. And then real estate investors calculate the internal rate of return and stuff like that out of it. But essentially, it's a cash flowing asset. When it comes to stocks, a lot of times the cash flow is not really that important. It's more the market value. So people are speculating on the valuation of those stocks and trading them. And here I think it's more of a buy and hold thing. So the liquidity part is not so expected. You don't need to create. I don't see real estate tokenized as being necessarily a day traders heaven for I don't see that high frequency trading activity happening on real estate. But if you just imagine an asset worth valued at 10 million in Ljubljana here, where I come from, it's not going to have many buyers. There's going to be a shortage of buyers because it's more or less private individuals who are going to be looking into buying this kind of assets. It's probably it might be a luxury something, but it's probably going to be a commercial type of investment. So there's not going to be a big line of investors here. Funds are going to be generally looking at much larger sums when it comes to buying assets, real estate assets. Individuals are going to be looking at much smaller investments. So the 10 million is probably not going anywhere. If you tokenize it, you do have the option to find liquidity for it over time. So this is, I think, the promise of tokenization is solving that gap that is present on every market. And the liquidity, nobody should expect they can just sell the tokens instantly tomorrow. You're buying to hold, you're making a good investment if you've done your research. And then when you want to divest from it, you don't need to do, a all or nothing. You can divest gradually, and the market should support that type of liquidity.
What do you think about sourcing liquidity through the collateralization of tokenized real estate? I know people are talking about that, especially if it's more transparent. That means that you can be a little bit more capital efficient, right? So greater loans and working within the loan to value of the assets. So is that something that you're looking at, that maybe people could be taking or borrowing against their tokenized real estate?
Definitely. This is something where we see a lot of value being created, but getting from here to there's certain steps that need to happen on the market, I would say. A lot of times, when you look at the DeFi lending, so how it works, you have an asset that you use as collateral, and the expectation of the protocol is that asset has a lot of liquidity. So in most cases, DeFi lending works, let's say, with ETH, with Ethereum. And And because, when somebody defaults, Ethereum can get on an auction and there's a small spread and the capital is recouped quite quickly and the debt is repaid in the protocol, so there's no deficit. When it comes to real estate, you get into the same issues as, commercial banks have. They end up with a portfolio of assets that non-performing in their loans, and they sell off those NPLs for big discounts at their expense, right? And that's actually, what happened after the crisis. A lot of banks had these large, huge portfolios. They didn't know what to do with them. And I think the risk if tokenized real estate goes into this DeFi lending direction too early before it really gains adoption on the market is that there's going to be a lot of protocols that are going to, be stuck with a lot of tokens that will be totally liquid. And that can, create a cascade of effects that then even makes those tokens even less liquid. But the underlying might be good. So in those cases, they're just going to end up with tokens of real estate assets that are of, good quality. There's a due diligence element on, enabling certain assets to be used as collateral versus others. And then we come back to the transparency and the standardization of what you can tokenize and how you should tokenize it. In the end, with tokenization or without, we come back to the traditional methods that the financial players are already using in traditional finance.
Right. I think so many in tokenization are trying to reinvent the wheel. And I understand why, because it does feel very transformative to be in the tokenization century, but not everything that currently exists within legacy systems and traditional finance is necessarily broken. It's evolved over time, actually as a result, right? You have cause and effect, and we realize this is how we should set up our risk parameters or compliance, whatever. Now, that's not to say that there aren't inefficiencies that technology could resolve, but we don't have to throw out the baby with the bathwater, I think. You mentioned standards, and I was in London recently with FIBREE and UCL, and we were talking about data standards, systems, and regulatory standards, and how to ensure consistency. Now, it was for the built environment, so it was more about construction and real estate as an industry, but I think it really applies throughout, actually, in a layered approach, the underlying assets, the capital stack, and then the smart contract. Right now, there's no consistency between tokenized real estate around the world. We don't know what's under the hood. We don't have reliable inputs, essentially. And so, I mean, even on the topic of valuation, we could say, hey, we have the valuation for the assets, but the way that we drew that conclusion, one person is using aggregated big data and another person is using a market decision. So, what the participants want. And then another person could still be using data from the actual property itself, right? On a granular level. So is this something that's Blocksquare, and of course you're on the board of FIBREE as well, is this something that you're pursuing, and how do you see these standards emerging so that we can have trustworthy cross-border finance?
Yeah, it's a tough one. I think that's something that we're all kind of jointly trying to get our head around how to make everything much better so that people can trust it, right? And I think with all the differences in protocols and we are clearly showing and approaches, we're clearly showing that there's no clear winner yet. If we go on to another topic like, tokenizing fiat, right? So stable coins. And back in 2016, you had Tether starting up somewhere from Hong Kong at the time. I think they were based there and they were moving around. Then you had MakerDAO, and then you had a bunch of other ideas. Circle, I think, came just a bit later with USDC. But you had a couple of approaches of how you tokenize fiat. And only today we see what the market is trusting. And currently the market is trusting USDC. Why? It's regulated. It's simple to understand. So that's it. But on the other end, the crypto market is using USDT made primarily for settlement. So, and both are kind of starting from the same concept of having a one-to-one backed stablecoin. You have USD in the bank account, and then you issue tokens, and then you have supervision over that those dollars. So you have proof of funds, and then maybe you're allowed to, and then you started investing into different paper and stuff like that. But then you had MakerDAO, which was the most promising one because it was the only one decentralized. But the complexity of decentralizing this system made it less interesting for the market. The market just didn't absorb it that well, even though it is the backbone of DeFi. So you still have these two kind of battling, this battle between the two approaches. I think with real estate, with tokenizing real estate or tokenizing assets in general, you're going to have the same thing. You're going to have different approaches. You have the approach of tokenizing shares of an SPV that owns an asset. That's approach number one. You have the second approach where you're tokenizing the economic benefits or the economic rights that derive from the ownership of the asset. And then you have companies that focus on one type and focus on the other type. For real estate, at Blocksquare, we saw that going with the first one, tokenizing shares, is adding so many layers of cost that in the end, it just makes for a bad investment, except if it's a property of 100 million, right? So you really need to go institutional there. And before institutional adoption comes, maybe it's going to be too late. And so we're focusing on the other route, tokenizing economic rights. Now that's much harder because you need to create products that create transparency. And so this last year, we started and launched something called Tokalytics, where we collect a lot of data on a real estate asset, and we create a risk report. And in this risk report, the potential investors see 100 data points presented on a PDF, but it doesn't, it still relies on the credibility of the data that you input. And I think that's then again a problem. Is the data that is being fed into the system the correct data? Has it been altered somehow? And I think this is kind of the major problem, is because you can't solve it. You are relying on archaic systems where documents are produced, from banks to land registries, title registration, whatever, and you're putting that all together into a risk report. And then all you can do is say the reliability of the data that I as a system received is good, bad, insufficient. That's all you can say. You cannot provide certainty, but people sometimes expect certainty, and it's not fair to not disclose that.
Great points. Just really well said. I like that. Well, let's talk a little bit about where you see the industry going in the next few years, what role Blocksquare is going to play in that, and then we can talk about Oceanpoint as well, and kind of introduce the audience to that service that you have.
Sure. Blocksquare, we started, as we said, back in 2018, unofficially 2017. There was a lot of ICOs at the time. We helped some on the tech side, structuring things. And then we also, in the meantime, were developing Blocksquare as the concept and how to go about it. We started very modestly, raised a small amount, and basically just went for an MVP. Said, well, let's do a small amount raise. Let's do an MVP. Let's show that this is possible. And we tokenized a single parking space. 18 investors bought into it. It was a small asset. I think it was 15,000 euros. That's around $16,000 at the time. And that proved the concept. Then we went, to Switzerland into an accelerator. So we really did the startup thing with Blocksquare. And now there's a team of around 35 people. We've tokenized 200 million worth of assets with partners mainly. So we provide infrastructure for other companies to utilize it. And our goal or our mission is to provide tools that basically promote transparency, that they promote standardization of processes, so that we kind of need to push our customers to do things in a certain way, but we can't force them, right? We can only try to direct them in the right direction. And so everything that we're building from here on is being built towards this goal. If you don't have certain documents in place, the user should be informed about it. There should be a red flag, on the UI. And you should not be, and we are in a position, we're positioning ourselves that it's in our interest to do that, because then our clients will be forced to present things as we believe should be presented. On the other end, we are trying to create products that will create a better user experience, because with a better user experience, then of course the clients we work with, they are incentivized to provide good product to them. And so we mentioned Oceanpoint, which is essentially a DeFi product, and in its roadmap, somewhere down the line, there's also the collateralized lending, so that people can borrow against real estate tokens in their portfolio. It's a complex part of the roadmap, and so we've left it towards the end if we really want to make it functional for the user. But in its initial stages, the main goal is to create a liquidity engine, so that when people buy real estate, they buy it from a property owner, right? And then there's a potential for selling it on the secondary market to somebody else. Now, when you put it on sale, that somebody else needs to come by and buy it from you at the price that you desire to receive, right? But that's a waiting game sometimes. There's not so much liquidity so that you can sell it in an instant. It usually takes a couple of days. It depends on the asset. With Oceanpoint, you will be able to instantly sell it to a DeFi protocol that will piggyback on automated market maker pools on the other side to kind of siphon this liquidity to the user. Obviously, you're going to be losing a premium, where you're going to be selling at a discount, and you're going to be losing on conversion. So it's a bad deal for you, but you do have instant liquidity. And I think that's important for some people to be able to exit quickly, at whatever price. And so the larger that we are able to grow this liquidity engine, the more useful it becomes, the lower the spreads and the losses for the user, and the larger the volumes that it can process.
Fantastic. I really see all of that becoming the future. We keep talking about liquidity, but it hasn't arrived. It seems like you have a genuine solution to manufacture that and to have it be authentic, actually. So I appreciate that. I want to give you a call to action. Is there anything that you guys are looking for? I imagine you want to tokenize more properties. Are there other partnerships or certain regions that you're trying to access as well?
Well, essentially, we're building Blocksquare in a sense of a DAO, and as a DAO, we want to get people involved, and people not just passively involved in what we're doing, but getting actively involved. And I know that there's a lot of people with a lot of knowledge, and we're welcoming anybody to knock on our doors, and when we can see how we can improve things. There's a lot of collaborations that we've done in the past, just because I oftentimes make this kind of call and then say, hey, just come to me and then say hi, and we're going to find a way of working together, because there's a lot of things. It's not just property owners. This is just a small part of the whole equation. And so, if you're somebody from real estate, finance, DeFi, Web3, whatever you call it, and you see that real estate tokenization is the future, come to us and let's talk. That's all I have to say.
Amazing. Nice and short. Well, perfect. Denis, I really enjoyed the conversation, and this is probably one of the best conversations about tokenization that I've had. And it's clear that you're an expert. You're so concise, and I think that One of the questions that I didn't ask is, what are other companies doing wrong? And it's kind of a weird question to ask, but it's true. It's happening. Not everyone is tokenizing equally. And I think that you have the right approach. I mean, talking about tokenlytics and the risk assessments of the properties. And that's why I admire companies like Particula that are trying to aggregate that data and make sense of that and provide that information. I think that's extremely important because this has become a highly risky industry, and it shouldn't be. It was supposed to be a better iteration of the current financial system, and somehow we did not accomplish that in the past 7 years. Now it's slowly turning around, and I really think that you have a role in that, and that's why we had this conversation today. Not to flatter you too much,
Thank you.
but it was really great sitting down, and I hope that you guys have continued success. And as a little CTA to all of our audience, if you really liked the conversation with Denis, first and foremost, of course, go to the show notes and reach out to him. But also, we would appreciate a 5-star rating on Spotify or Apple, thumbs up on YouTube, or a subscription. It really helps the show grow, and we can continue to bring on fantastic people like Mr. Denis here. All right, Denis. Well, I'm wishing you a fantastic rest of your evening, and hope to see you around.
Thank you, Matthew. It was a great conversation. It's always great to have somebody else who understands the topic as well as you do, and you definitely do. So it was a real pleasure. I hope we can meet face to face sometimes and not just online. So, if you're going to be at certain conferences, and, looking forward to it. And thank you again for having me.
Yeah, we'll make it happen, and we'll change the industry together.
Perfect.
Love it.